The plan is to have 20 minutes for each participant and then 5 minutes Q&A at the end of each paper, if it's okay for you.
Okay, that's fine. So thank you very much. I will try to share my screen.
Let me do the introduction, Joel.
Yes, please go ahead. No.
Should we start now? Okay.
Yes, we can start. Yeah.
Okay, so I'm very happy and very honored to chair this concurrent session dedicated to LNG economics. So my name is Laurent. I'm currently head of the strategy department for the gas power and renewables segment in Total. I've been working in the LNG since 2014, and I'm still thrilled by how this market is evolving with cycles and investments and prices. And I think it's very interesting to have researchers providing papers to help us to understand this moving market. So this morning we have 4 panelists that will present their papers. First we have Joel, then we'll have Massita, Sarah, and then Massita, and after we'll have Franziska. So each panelist will have 20 minutes to present his or her paper, and then we'll have 5 minutes of Q&A. So for the audience, please feel free to ask your questions either directly or through the chat. And then let's start with Joel, please.
Yes, thank you very much. Hello, everyone. Thank you, Laurent, for the introduction of this very interesting panel session. My name is Joël Enderlin, and I am head of shipping economic studies and projects within Total. So today it's more linked with oil products and crude oil for me, but in the past, I used to develop the modeling tools for Total in close collaboration with Laurent. That's why I'm really happy to have the occasion today to show what we do inside or within our company. And I can tell you it's always a pleasure with Laurent to take some this kind of occasion to show out of the company what we do, how we proceed, if we are far from the university level or not. So it's always interesting to share a little bit of our own expertise and our own motivations for this kind of modeling stuff. So today, let's start with a presentation of a model we developed to analyze and to understand LNG trading and LNG shipping patterns. And of course, let's start with some greetings from the law department. And of course, to tell you that everything in this presentation and in the PowerPoint cannot, of course, commit Total Energies in any way, of course. Now, much more interesting, what are our motivations? So what we see here is that the LNG market, as introduced by Laurent, has quite evolved in very large scale over the last couple of years. So here I take a time horizon of 6 years, and even if in this period we see large developments in the LNG market. So first of all, on the left side we have the LNG global demand, which evolved by a CAGR, a compound annual growth ratio of 8% from 2015 up to 2020. So there is very low, limited energy sectors, which proves these developments in a so little time horizon. But on the top of the volumes development, there is also other structural developments in this market. And first of all, we have portfolio players who have gained weight in the market from 2015, and which are players such as Total, but we may think about other big players on the market, which provide more optimization in the markets in terms of flow allocation and price structure, because they are playing aggregating roles for both supply and demand. So they are portfolio of demand buyers and portfolio of suppliers. It's a structure of market which is evolving and which is quite far from the historical market structure which were based on long-term contracts between plan to plan or country to countries. So this is the second structural development we want to show you. And the third one, of course, is when you increase the level of volume which is produced and transported, it comes with an increase in the number of exporting and importing countries. So it has quite double since 2020 in terms of importation. And the same for exportation and increase. So it's a quite fast evolving market from the trading side. Now, from the shipping side, on the right side of the slide, you have a graph which shows the evolution in the shipping demand. So for those who are not used to see this kind of things, we express it in BCM miles. It's to measure, to give a quantitative value over the transport of LNG. The idea is to transport 1 BCM, so 1 billion cubic meter over 1 mile of distance is the same level of transportation than transporting 1,000 BCM miles, 1,000 BCM on 1 BCM on 1,000 miles. So it's really a way to make a quantitative analysis of the shipping demand. And what we see that, of course, it has evolved at the same level as the LNG annual demand. So there are two opposite reasons for this. First one, of course, is the multiplication of exporting and importing countries, which comes along with an increase in distance and volume. So we have this increase in the transport, in the volume of transport of LNG transported. And at the opposite, as we have an increasing role of portfolio players, we have also a more optimized trade flows, which allows a more optimized markets. And so this tends to reduce the shipping demand. So all in all, we see here that it comes along with the same level of development as the LNG trading, but it's not sure. It really depends on the market's development. So the main idea here is really to make you understand that from our point of view, it's the market has really evolved over the last couple of years from a structural point of views. And for this, we developed LNG a market model, which provides insight in both LNG trading for the left side and LNG shipping on the right side. So I will first present you the LNG trading model and then the shipping model. So here a bit less colors on this graph, but I think it's the best way to explain in details how does our trading model work. So it's a fundamental model on LNG trading patterns. And for this, of course, we have a set of physical and economic constraints. So if we take the first one, the most important one, it's the LNG production. So in our model, we model the monthly train by train available LNG production. So for each train in the world, in the past and especially in the future, we model, for example, the ramp up of new built trains for trains which are under development or which will start produce in 1 year, 2 years, 3 years forward. We also have a view on the periods of maintenance, because when we saw this last summer when Indonesian and Malaysian trains entered into maintenance or faced some difficulties, there was a lack of LNG on the Asian market. And of course, we also have some view on the depletion of upstream reserves for LNG plants, which are based on what we will call historical business plans. So these are integrated plants, so LNG plants integrated with the upstream natural gas production. And of course, all these physical constraints are linked with some view on the production cost. And in this case, we consider that all LNG production costs are stranded for integrated assets. In the short term, it's really to make trading choices. So in the short term, for today, tomorrow, in the prompt, we don't consider any costs which can impact the flow allocation from the liquefaction level, but we use just for the US liquefaction trains, which are more modern and which have different business plan. We use the proxy of the renewable, so the local domestic natural gas price in the US that we use as a reference plus a tolling fee. So this is a quite detailed view of the LNG production. Then all four other topics are developed in the same way. So of course the LNG demand, monthly LNG demand for each balancing zone in the world, so especially in Europe, in Asia, in North America, South America, with a view on the sectoral demand. So does the country need natural gas for power market or for cooking or this kind of things? Then a view on other natural gas infrastructures such as storage, so delta storage, domestic natural gas production of the country, and of course to close the balance, it's a question of natural gas pipe imports and exports. And in this way, we have a view on the LNG demand for each balancing zone. And then the regasification is quite same as the LNG production. We model it on a train-by-train level, with a view on the ramp-up for new build trains and periods of maintenance for existing trains. We consider no regasification cost as they are stranded. Actors book regasification capacities on the long term. So in the short term, we consider there is no impact on the flow allocation. And finally, what will be also very interesting for us is the LNG shipping. And here, the key item or the key topic is the distance of each train to each train. We model the shipping on a train-to-train distance. So it has a cost because we associate it with LNG carrier long-term break-even cost. In the first approximation, we consider there is an unlimited capacity of shipping. We will see this in a second step. But in the first approximation, we consider there is no limited capacity of shipping. And of course, we model the Suez and Panama channels, and also in close details, the boil of gas, so the level of gas which is evaporated in the tankers and which has both physical and economic impact. And of course, on the top of this, we model LNG contracts with destination clauses to force LNG to go from a given point to another point if some contracts have been signed. So here, what I want to show you is that the main cost in terms which will impact the flow allocation comes from the shipping, and especially from the distance. What we see also on the market is that the shorter the distance, the higher the probability to see LNG flowing on this route. So when we bring all together all these topics, we then proceed to a LNG flows allocation based on a cost minimization. We will minimize the cost of the whole system to meet the demand given with the production. And as we have based on the cost minimization, of course, you understand that LNG will take the shorter distance to be transported from the production side to the demand side. So this is the main idea, but it's indeed what we consider, what we do every day on the market. And of course, the main assumptions behind this is that the model works in pure and perfect competition. So this is the main idea of the model, and then we'll just go through a couple of slides to show you some results. So on the left side, you have the actual flows, so the monthly Middle East exports by importing region. So for example, here, what are the destination of Middle East exports? I won't detail all of them, but you see on the left side the actual flow, and on the right side the output of the model. So they are quite close. There are some differences, but I won't detail all of this because I understand that I am already a bit late. But the idea is to show you that here it's less interesting, but you have the ramp up of Australian exports with a destination which is mainly Asia, of course. Here, some view on the monthly Asian imports by exporting regions, so this is the other side. And here, one thing interesting to note is the seasonality of imports, which are directly linked with the seasonality of demand in Asia, because very low storage capacities to absorb the seasonality, which is different from European imports, for example, which we consider mainly as a buffer market. And here, it's typically see the impact of the increasing Russian and US production from late 2018. And so the only market who could absorb these additional volumes of LNG was Europe. So you really see here the impact of these new global capacities, and which are absorbed by Europe. So the main conclusion here is that even if you have some differences, the model managed to build the flow allocation in quite good conditions, and we managed to build a coherent view, consistent view with historical patterns. So which tends to confirm the quality of the model for our needs. Now we have a trading model. We will compare it with the shipping at the shipping layer. And for this, just a quick view on the fleet development. So how do we study the shipping capacities? So what we will call the shipping supply is to have a view to monitor the transport capacity for each month. So this is a quarterly view on the shipping fleets, especially on the right side in green, you have the development of the global fleet, and you see that it has increased very fast over the last couple of years to reach close to 600 vessels today. So it's a major fleet development. I can also would like to take a few moments, but the idea here is that it's evolving quite fast, and you have large industries which is developing on this side. But this is a view on the shipping side. And so what do we do with this shipping side, with shipping supply and shipping demand? So the shipping side here on the left side, you can see here the line is shipping supply. So based on the number of vessels which are available every month, and we will compare this with the shipping demand which comes from our model. So we assess both of them in BCM miles. We convert the number of vessels in BCM miles through an assumptions on the vessel speed and vessel cargo. But the idea is really what we do in the trading and the shipping is to compare always the supply and the demand to see if there is a balance or an imbalance. If the shipping demand is much higher than the shipping supply, which was the case in 2015-16, we may expect shipping rates. So the cost of the price of chartering a vessel on the market to be very low. And at the opposite, when we have a demand which is higher or which come closer to the shipping supply, we may expect time charter to be higher because we have more pressure on the market. So the idea here is to build this balance, and we do it quite easily just by making the division, the ratio of the shipping demand over the shipping supply, and in this way we get what we call from our side the global LNG fleet operating rate, which gives us a good view on the market pressure. And so last slide, what we do with this operating rate. So we used the 2012 to up to 2019, so about 8 years or 7 years, to compare the monthly charter rates with the monthly operating rate we had from the market. So on the blue side, you have the spot charter rate, historical spot charter rate, which declined here with a bottom point in 2015-16, and then which enter in a new pattern. I don't want to describe this too much now because I have no time, but with more seasonality. And what we see is that the operating rate is presents quite same patterns in terms of development. So indeed, what we did is to plot the charter rate as a function of the operating rate, and we got a correlation of 80%, which tends to confirm our main assumptions is that the spot charter rates of shipping industry in the LNG market really relies on fundamental patterns of shipping, the LNG shipping, so in terms of shipping demand and shipping supply. So all in all, what we did first, if I sum up, is that we managed to build a market model for trading. So by building a view on the flow allocation of LNG, and in a second step, we complete this with a shipping model to assess the spot charter rates for the market, for the industry, based on the fundamentals pattern of the shipping market. So thank you very much for your attention. And of course, I wait for your question. Thank you very much.
Thank you very much, Joel, for this very interesting paper, of course. Is there any questions in the audience?
You can raise your hand.
Yeah, virtually, I'm not modeling that. Maybe I can start. Thank you very much. It was really a very interesting presentation, a very impressive model. You presented a lot of detail on your data assumption. I still had a question on your upstream costs, basically on your gas extraction costs, or the cost at which the LNG liquefiers purchase. You mentioned Henry Hub for US. Then I didn't quite get it for other countries, because there are huge differences, and I wonder how you take that into account.
Yes, I understand, and I agree with you. It has a very important value or interest in case where you developed an investment model, when you want to choose between one LNG project or another LNG project for the long term. But here it's really a matter of trading. So in the short term, I can tell you that people or buyers or sellers don't see at the production cost. They have a volume, and they tend to maximize their value. And you cannot stop a LNG plant from one day to another day if you lose money. So you produce whatever happens for most of integrated plants. So in this case, for the upstream, indeed, we don't have any supply cost even for the liquefaction plant. It's really a model for LNG trading, so really for flow allocation in the short term. But indeed, it's key when you make a long-term model with investment patterns. You have to focus on the capex, the opex, lots of things which are related, and especially for fiscality of the country. It is key, but in this case, it's we consider this cost as stranded. I hope
that's very interesting. Yeah, it's different from the logic I had in mind. It's really interesting. And maybe I can have one follow-up question. I was wondering if you take the duration that it takes to bring a ship from the liquefaction plant to the regasification plant. Would you take that into account? Because you have a really short granularity with your monthly data.
Yes, to be honest, we don't take it yet. But it's our plan. We have set a large series of development ideas in terms, of course, of this delay, because when you export a vessel from the US to Asia, it may take up to 50 or 60 days. It's very long, but we don't take it into account. But it's the same way we want to improve, for example, the model by also modeling the ballast flows. So when you export a vessel from US to the Asia, then you have to find another place to go laden, so without any cargo. So it's this kind of things we want to model now, but it takes time, and it's really getting very thin details on the shipping market. But at the moment, we don't take into account this delay, unfortunately.
Other questions? Maybe I just try to trigger the flow of questions. I have one question. Joel, how do you take into account the diversity of the LNG carrier fleet in your model?
So indeed, the diversity in terms of vessels, right?
Yes.
Yes, indeed, we have witnessed a very large development of new technologies in terms of LNG carriers, moving from old steam carrier up to now new ME-GI, so new gas injection at high pressure on the motor vessels up to over the last 5 or 6 years. So we have very different classes of vessel. I make it very easy to understand, but for example, what we model here is the main spot charter for the standard vessel we have on the market now, which is a 160 cubic meter vessels, so vessel which can transport 160,000 cubic meter of LNG. But you have no vessel which are which are bigger. So the 174 cubic meter ME-GI vessel, which are the most modern and which are more expensive on the market, and behind some 140 cubic meter which are steam produced. So which are much older vessels and which are much expensive which are much cheaper on the market because they consume more fuel, so people don't want them. So here I've made the spot chart, the correlation for the spot charter rates of the DFDE, so dual fuel diesel electric 160 kilo cubic meters, but then we have some correlations to correlate the rates between each class of vessels. So we first do the correlation for the main class of vessel, and then depending on the vessel type and also from the basin, because we have different prices in the Atlantic basin and in east of Suez, we have some other correlation which are at the moment are working quite well, but which can also evolve when you have the spike in Asia or in the Atlantic basin. Of course, they will decorrelate, but most of the time the correlation works quite well.
Thank you very much. The last chance for last question. Okay. Thank you, Joel. Thank you for this presentation. Thank you for those who asked questions. And then I leave the floor to Massita.
Thank you.
Okay, thank you. Okay. Can you see my screen?
Yes.
Okay, thank you.
We can hear you very well.
Yeah, okay. So good day, ladies and gentlemen. Thank you for attending my presentation session. I'm truly honored. First of all, I'd like to introduce myself. My name is Massita Yusindi. I'm a researcher from Purnomo Yusgiantoro Center, or PYC. PYC is an independent and non-profit organization. We focus on research in energy security in Indonesia. So basically, we are open for any collaboration with an institution that have similar interests with us. So today I'm going to talk about our recent study about feasibility study of flare gas utilization through a small-scale LNG in South Sumatera, Indonesia. It was a study that we held in 2019 in collaboration with private investors that have initiative to maximize the utilization of flare gas and monetize it into LNG. And so we did the economic feasibility calculation according to the existing regulation in Indonesia. So what is flare gas? Maybe some of you are already familiar with this terminology, but maybe some don't. So there are a lot of perspectives regarding the definition of flare gas, but according to our understanding, the flare gas is an excess gas from hydrocarbon production which can no longer be recovered or recycled. It usually consists of methane as a dominant composition, around 80%, and then there are also propane, butane, ethane, and other gases such as sulfuric acid and other sulfur compounds. Basically, the composition itself is very similar with natural gas. And then the next question is that why it should be flared then? Why not just sell it like natural gas? So there are at least 3 reasons why the flare gas is burned off. First, the flare gas is usually economically unattractive. So the investors are unwilling to construct production facilities as it is only generate a small revenue. It especially could be found in the oil field that has associated gas, meaning that there are gases trapped in the oil. The gas should be separated from the oil so that the oil could be sold and processed. The gas itself actually could be sold as natural gas. As I mentioned before, because it is very similar with the natural gas. However, usually the volume of gases is very small, but require high capital and operational costs. So the margin generated is very minimal, not to mention the fact that it is hard to find a buyer with a high uncertainty of supply. That's why many companies prefer to flare it rather than sell it. And second, some gas should be flared as a safety reason because some oil and gas fields burn flare gas to maintain pressure and release risk of explosion from simply venting large amount of reactive gases. And the third, releasing the excess gas directly to open air is believed to give more harmful to the environment. That's why companies are instructed to flare it rather than just release it in the form of natural gas. And next, where is the major flaring taking place? According to the World Bank report in 2019, between 2013 to 2017, Russia is the biggest flaring country, followed by Iraq, Iran, and United States. Indonesia itself is in the 15th rank out of the top 30 gas flaring countries. Actually, the gas could be used for various purposes, but according to the IAEE regulation number 32 of 2017, this is the existing regulation in Indonesia, flare gas can be utilized as the power plant, city gas, LNG, CNG, dimethyl ether, and others. Because basically, again, the composition itself is very similar with the natural gas. The problem is how to make it profitable enough or interesting enough to be utilized by the investors. So the objective of this study is that we aim to conduct an assessment of the economic feasibility of developing an SSLNG or small-scale LNG from flare gas. We studied an oil field in South Sumatera, Indonesia, with associated gas content in their crude oil. The associated gas was actually already used as power generator source in the field, but there was still excess gas left that usually burned off as flare gas. That excess gas was the flare gas that we plan to utilize as SSLNG and try to calculate the profitability. The economic assessment was conducted into 3 main steps. First, we calculate the profitability analysis, then the sensitivity analysis, and the scenario analysis. And lastly, we try to analyze the result. And so this is the methodology. In this study, we collect data from expert interviews and previous literatures. As mentioned before, we used three methods of analysis that were done sequentially. First, the profitability analysis, sensitivity analysis, and the scenario analysis. So this is the profitability analysis. The profitability analysis was conducted to analyze the profitability of SSLNG development. We analyzed the NPV, the IRR, and the PP or payback period as the financial indicator for profitability analysis. We also make several assumptions to be put in our calculation. As seen on the table, we have the flare gas price, interest rate, exchange rate, LNG selling price, the total OPEX, and also the total CAPEX. In this calculation, we also include the depreciation cost and also taxable income of 25% according to the existing law. Okay, and this is the estimation of the average flare gas production per year. As we could see, the volume of flare gas is considered very low as it mostly below 3 mmSCFD. The average of flare gas for 10-year project is about 1.79 mmSCFD, with the peak production is occurred in 2024 or the 4th year of the project if the project is started in 2021. And then this is the sensitivity analysis. We conduct sensitivity analysis by evaluating 5 variables. First, the average flare gas production. Second is the flare gas price, LNG selling price, change in capex, and also change in opex. We study the sensitivity degree of each variable against 2 factors, the NPV and IRR. We also try to find the minimum or maximum point of each variable to be able to achieve positive NPV, 10% IRR to make it higher than the discount rate, and 14% IRR as this is the desired IRR that the investor wants. We try to calculate and we change it alone while the other variable are ceteris paribus or same with the previous assumption. And at last, we perform the scenario analysis by integrating the external factors such as existing regulation and economic assumption to determine whether the SSLNG project is still possible to be continued in the study area. As for the scenario analysis, we consider 3 external factors as follows. First, the MEMR regulation number 32 of 2017. This regulation, according to this regulation, the flare gas buyer shall be set through tender by SKK Migas with the price between 0.35 to 3.67 US dollar per MMBTU, which means according to this regulation, our flare gas price should not be lower than 0.35 US dollar per MMBTU. And then there is a presidential regulation number 40 of 2016, MEMR regulation number 8 of 2020, and MEMR decree number 89 of 2020. All of these regulations have set new natural gas maximum price of $6 per MMBTU for several industries. Although the regulations are yet to cover all the natural gas end user, this benchmark price should be considered to guarantee the market competitiveness and to attract buyers. So we should put the LNG selling price to the maximum $6 per MMBTU at the end users. And the last, based on interview with the business experts, the maximum capex decrease is 40%. And then we select and modify 3 variables. First, the flare gas price, second capex, and the third is the LNG selling price. We try to find the best formula between these 3 variables so that we could generate positive NPV and also 14% IRR. Now, let's look at the result. In this slide, show the percentage of capex and opex component that were used in this study. Based on our calculation, the processing facility will dominate the capex by taking 82% of overall capex. The reduction of processing facility will significantly increase the profitability of the project. Meanwhile, on the opex side, the transportation cost will take more than half of the overall SSLNG project's opex, followed by the storage cost and then flare gas price. However, since the transportation cost is depend on the distance between the end user as the buyers and SSLNG location plan, this variable is unlikely to be adjusted unless the SSLNG plant could be relocated. And although storage cost is dependent, on the flare gas volume, so it is highly also impossible to be adjusted. Therefore, other OPEX components such as flare gas price could be the target of adjustment to reduce the OPEX. And this is the cash flow for overall project. We use the cash flow projection in a 10-year period to evaluate the project profitability. The figures show that SSLNG project will start to generate profit in 2027 if the LNG production start in January 2021. According to our calculation, the IRR will be 7% and the IPV would be about $800,000. IRR should be above the assumed discount rate to be considered as economically attractive project. Thus, although the SSLNG development project would have a positive NPV, it is still economically unattractive. However, there are possibility of achieving higher IRR up to 14% if some variable can be adjusted. That's why we conduct sensitivity analysis as well as scenario analysis to see which variable should be adjusted and on what degree it should be changed. So this is the sensitivity analysis result. This is the sensitivity analysis for the average flare gas production. As previously stated, the projected average flare gas production is 1.79 mmSCFD within a 10-year period. However, the sensitivity analysis showed that the projected average flare gas production should be more than 1.97 mmSCFD for IRR value to be above 10%. And to reach the desired IRR of 14%, the average flare gas production should reach 2.15 mmSCFD or 20% more than from our field data. Meanwhile, the slight decrease of average flare gas production to, let's say, 1.70 mmSCFD could generate a negative NPV. This makes the volume of flare gas production become overly sensitive to the project profitability. However, since the volume of flare gas is related to the oil and gas field capacity and production capabilities, it is unlikely to be easily adjusted unless there is a new discovery in the field. And this is the sensitivity analysis of flare gas price. The results show that the flare gas price is one of the most sensitive variable with the change. However, it is impossible to achieve the desired IRR by changing the flare gas price only, because even the zero flare gas price, which means the flare gas did not have any value at all, the IRR value is still unable to surpass its discount rate of 10%. Thus, it is important to adjust other variables along with the flare gas price adjustment. And next, this is the sensitivity analysis of the LNG selling price. The result is that LNG should be sold above 6.8 US dollar per MMBTU to exceed the discount rate of 10%. And it should be sold at higher price at around 8 US dollar per MMBTU to reach 14% IRR. This means that although the increase of LNG selling price could help a small-scale LNG project to reach the desired IRR of 14%, the government natural gas price regulation of 6 US dollar per MMBTU will lower the competitiveness as it is significantly higher than the regulated price. This is the CapEx change sensitivity analysis. It is found that the CapEx need to be reduced from about 10 million US dollar to 8 million US dollar or 20% decreases from the initial calculation to surpass the 10% discount rate. And it should be decreased further for about 40% from our initial calculation, or from 10 million US dollar to 6 million US dollar to reach 14% IRR. And the next, this figure show the impact of OPEX change to NPV and IRR. The results show that the OPEX should be reduced from about 20 million US dollar to 16 million US dollar or 20% from the initial calculation, so that the IRR can surpass the discount rate of 10%. Meanwhile, we found that the OPEX has to be decreased by more than 50% from our initial calculation, or from 20 million US dollar to 10 million US dollar to achieve the desired IRR of 14%. So the CapEx variable is proven to be more realistic to be adjusted to achieve the 14% IRR for this project, because reducing 50% of OPEX is probably impossible to be done. Now we are moving to the scenario analysis. The variable used in the scenario analysis are solely on the flare gas price, change in CapEx, and LNG selling price, because these three variables are considered to be easily adjusted to reach the desired economic criteria IRR of 14%. As you can see, this table shows the result of 24 scenario analysis that we have gathered. So all of these 24 scenarios are the required number that need to be fulfilled in order to reach 14% IRR. However, if we consider this true external factor in the left side, which is limitation, only 2 possible scenarios left for this project that you can see from the blue highlight and the checklist. The results show that to fulfill the external factor requirement, as well as to achieve the IRR of 14% and positive NPV, the project should have a minimum LNG selling price of $6 per MMBTU or higher. And then the maximum capex should be about $6 million or 40% less than the basic scenario. And the maximum fair gas price should be about $0.5 per MMBTU or less than that. Okay, to sum up, there are 2 conclusions at this study. First, we learned that the change in average fair gas production and fair gas price can affect the economic calculation significantly for this project. And second, we conclude that the development of the small-scale LNG is not feasible unless there are several adjustments applied. First, the LNG selling price should be set around $6 per MMBTU or above. We also have to reduce the capex 40%, about from $10 million to $6 million, and then the fair gas price should be set $0.5 per MMBTU or less than that. And finally, I like to give a number of recommendations for further research. First, the fair gas price, as one of the most sensitive variable in developing LNG, should be flexible in the business-to-business negotiation. Second, further research should be test the optimum distance between the LNG plant and buyer to generate higher profitability. This is because considering the significant contribution of transportation costs in the OPEX. And the third, the possibility to develop alternative distribution infrastructure such as terminal hub and pipeline to reduce the transportation costs. And lastly, the similar calculation like this could also be conducted for CNG plant to compare which is better to be developed for further research. That's all from me, and thank you for your attention.
Thank you very much, Massita. Very clear, very interesting, because flare gas is one of the main topics used to challenge the gas role in the energy transition. So it's an interesting point of view that you propose today. If there are any questions for Massita, please raise your hand. Joel?
Yes, maybe. Thank you very much, Massita. It's really interesting, but I'm not so used to deal with this small-scale LNG plant, so it's really interesting to get these insights. But I should say I was a bit surprised by the low level of capex, so $10 million. It seems to be, I don't know, but I was surprised. Just wanted to know how confident or what are your sources on this, because it's really interesting, and I think if it's not working today, maybe in a couple of days or years, it could be very interesting. So just know where does the information come from, please.
Okay, for the capex, all the information came from the investors. So actually, we contacted the investor from China for this case, and they give us the calculation for all of this small-scale LNG investment that we have to prepare to build this project.
Okay, well, it's a very good message for me. Thank you.
Yeah, you're welcome.
Just to rebound on the Joel's questions, I was also surprised by the 40% decrease you mentioned for those capex. What are the drivers behind this such a decrease? Is it technical improvements or?
Well, so this is after we are conducting interview with some business expert and also from the investor themselves. They think that it is still possible to like negotiate the price and maybe like reducing the volume of the processing facility, something like that. But mostly I think it's from the negotiation process. They think that they still capable to reduce the price to 40%, but not more than that.
Right, it's quite huge. All right, thank you. Any other question from the audience?
I would have one.
Yeah.
I was actually almost the entire presentation, which I found very interesting, thinking that you would recommend actually to build the terminal, and then you ended up concluding it's not profitable. And I was wondering if you actually, I found your selling price, the LNG selling price, rather optimistic. I mean, a sustained $6 or even higher may not be feasible. And I was wondering if you'd also tried lower. I saw you tried 5%, but you didn't show the results. But in the past, we also saw even lower than $5. I'm sorry, $5 per MMBTU. And it's interesting that even with those optimistic assumptions, you recommend not to build the project eventually. So my question is actually, did you try lower LNG selling prices than $5 per MMBTU?
Yeah, actually tried to set the selling price lower than $6 per MMBTU, but we have to get the higher fair gas price and also higher capex decrease. So according to our external factor, it is hard to be achieved. So I also agree that $6 per MMBTU is a quite optimistic for this case, because fair gas maybe is not very secure in supply or something like that. So maybe the payer wanted to be lower. So yeah, so yeah, this project is almost in fact impossible to be done. We just try to give the slight, picture to the investor whether they want to adjust their variables, and this is what they have to be. They have to do to achieve the positive NPV and 14% ARR.
And one last question of understanding. You mentioned at the beginning that the flare gas that you investigate has a content of methane of 80%. I thought that usually sold natural gas, LNG, has a higher methane content. So in the course of the processing, would that have to be, that methane content to be increased? So is that part of the processing costs?
The process of the LNG is only to filtering the methane from the others composition from the sulfur or something, but it's not increasing the methane content. It depends on the field. The methane content is, it can, I don't think it can be increased.
Maybe if I can just give some just an opinion. It's really interesting, and even if today it's maybe not positive, maybe in the future, in the long term, if you can think about the climate change, I'm sure that this kind of project can benefit from the reduction of flare gas as an impact on the climate change, and maybe you can get additional revenues from the limitation of methane emissions. So it could be a good project in the future, which could be key to limit the climate change.
Yeah, Thank you, Joe. I think that this project is also important, and we try to further take another research for this project and try to find out how to utilize the flare gas with with all the limitation, especially in the very small field, how to make it more profitable or interesting.
Yeah, jumping on what Joel's comment, you can imagine with the structure constraints on flare gas, you can imagine that the flare gas price is 0 or even negative. I don't know if you have considered that, because it's a fatal product. At the end, you have to burn it, and it has environmental impact. So I think the NPV will be, and it will not be so foolish to consider a flare gas price at 0, or why not negative price, and then the project will qualify.
Yeah, we already calculate the flare gas price. How if it's 0, but even the 0 price still cannot make the RR at least surpass the discount rate. So maybe we need to. Actually, one of the problem in Indonesia is that there's no different regulation between the small LNG plant to the large scale of LNG plant. So maybe if there is like incentive or something, it can be more profitable. But there is no some kind of regulation in Indonesia right now.
Thank you very much, staff and all the panelists for the discussions. And now I leave the floor to Sarah.
Hello, everyone. Thank you very much for the previous speaker. I think this sets a nice background for my talk. My name is Sarah Najm. I'm an assistant professor of economics at Saud University. Today, I'll be presenting a co-authored paper with my colleague from Japan at Dewa University, Kenichi Matsumoto. This paper actually was work in progress in times of submission to the conference. But in the meantime, COVID and life happened, so we managed to publish it in Energy Economics. But nevertheless, any comments are very much appreciated, as we're also now thinking of ways to expand this work. Our question is whether renewable energy substitutes LNG international trade in the energy transition. However, as you'll see shortly, we focus more of a macro scale or a global scale. So it would be maybe interesting to extend this towards some micro analysis. So to just set some background statistics, which I'm sure everyone is aware of this data, but just to set some premise. As you explained nicely, how there's increasing dependence on natural gas. But in general, if we take one step backwards, we can understand even from various discussions yesterday in the conference that despite all this, let's say, massive increase in renewables and investments and climate targets, if we look at a global scale, we remain still heavily reliant on fossil fuels. And this will still expected to remain for a while, unfortunately. And within that, we have natural gas, and specifically LNG trade is increasing rapidly over time and expected to dominate future natural gas trade. However, if we look at maybe start to break different markets and look at maybe the European markets or think about the environmental perspective, as was mentioned earlier, the flare gas issue or the methane leakage and all these issues, natural gas is maybe slightly becoming less popular as a future in the future or its role in the future energy mix. So it's just to present here this policy dilemma is what is the role of natural gas in the future, especially in climate change. It might be uncertain. And specifically what we're interested in here is to see the impact of, let's say, increasing in renewables. Does it really substitute fossil fuels or LNG in specifics, or are we just increasing our dependence on all sources simultaneously? Especially, of course, at the global level. So bear in mind that our approach at the moment is at a much macro scale, but of course, we'll try to reflect in more details on some regions. So what do? We aim to examine the impact of energy transition policy, proxied by the share of renewable energy to total energy usage in important countries on LNG trade. So this is conducted in a panel global data set between the annual period 1988 and 2017. We use standard econometric techniques, including fixed effects and GLS estimator, following loosely a trade gravity model, which I will explain in more details what does it. So before I proceed with the nature of data and variables, I'll just set the question again of whether renewable energy substitute international trade in the transition. It may seem a simple question, but as you may expect, the answer is not really yes or no. But to a certain extent, at least at a global level, according to our results, we do find evidence in favor of partial substitution between the rise of alternative energy and LNG trade. However, the results or the story becomes less straightforward once we distinguish between regions in general, or even somehow time periods. But overall, we have evidence in favor. We represent this as partial substitutes because the magnitude is not very large, it's less than 1, but it's still evidence, let's say, in the right direction. And we'll provide some reasons behind this and who are the key players behind this substitution effect at the global. So I will continue with the main contribution and more details on the data and variables used and the econometric specifications. And finally, I will conclude and provide further thoughts on policy implications and further work. But just to explain, due to time constraint, I won't go through the literature review or the theoretical background, but of course you're more than welcome to ask any questions, and it's also in detail available in the paper. But I'll just focus on the applied side to be more. So contributions, without going in great details, but in general, if we look at the literature overall, we find that LNG trade dynamics are very much underexplored in the literature from an economic perspective, compared at least, of course, to oil-related studies. And even if we dig deeper, most of, at least in the time of writing the paper, we find that the focus is mostly on, at least econometrically speaking, or from the economic perspective, on what are the factors behind trade, determinants of LNG trade or natural gas trade, with pure focus on standard economics, such as the trade cost, let's say, but without due consideration to role of environmental factors or alternative. So what we try to do is basically bridge this interaction between alternative energy and type of fossil fuels, that is LNG. And by doing so, this allows us to combine between different literatures, including the green paradox, which loosely could fall, our study could fall also under this, since it looks at this paradoxical outcomes of green policies, that is whether initially started seminal work by Sin 2008 and followed by Sin 2012 in the book. You'll see that it's looked at paradoxical outcomes and whether, for example, the rise of alternative energy could stimulate excess production of fossil fuel. So we don't look at production per se, but this interaction effect also allows us to comment on the leakage effect. So is the rise of alternative energy, all else equal, potentially amplifying emissions through affecting the energy sector? Okay. And furthermore, this allows us to comment again on the substitution effect, and that's the main, basically, even title of the paper, of the extent to which do they substitute one. So generally, this is how our framework looks like. It's an econometric framework using panel data sets. We start off with it's a trade gravity model, meaning that the dependent variable is a trade variable, and specifically in our case is a LNG trade variable. As I'll explain shortly, we include various types of specifications for the dependent variables, just for further robustness checks, but essentially our interest rate. This is conducted using an unbalanced panel data set. It's a large data set, over 1,300 trading partners in the data set, global scale. But as a first step, we conduct some subsample analysis, first in two ways. We distinguish first between country groups, but a very generic distinction from an economic perspective, that is OECD countries versus non-OECD. And finally, we consider the role of different time periods during this. So to begin with, again, more theory behind the econometric specification is available in the paper, but practically this is our fixed effect specification. On the left-hand side variable, we have Y, which represents the LNG trade between trading partner K and time T, while our independent variables represent various types of variables, including conventional variables used in the trade gravity literature of GDP of exporter and importer. Green is our main variable of interest, in which I will explain shortly how is it constructed and what is the implication we expect. And finally, we have a vector of remaining controlled variables, including price, degree of the weather, and how this could affect also on the demand for LNG. And finally, the role of WTO, which I will also explain in the following slide. We include both pair country fixed effects in the specification and time fixed effects. This allows us to also account for changes that happen over time, but also the differences between country groups. As expect, that changes are dramatic if we look at the global level, especially when it comes to LNG and importers, because it's very much spread maybe in terms of institutions. Our dependent variables, as I mentioned, it's a trade value for LNG. It's basically our main dependent variable, but we conduct the analysis across 4 specifications, which just to for further robustness steps and to see to what extent results hold. So that is value of LNG volume and also value per GDP and volume per GDP. Essentially, value per trade value LNG is our variable of interest as a focus, but we receive get mostly similar results, at least variable of interest across all. Okay, so green is our independent variable of interest to measure the extent to which there's this switching or substitution effect between renewables and LNG trade. It's a readily available index at the World Bank. It's the ratio of renewable energy consumption to total energy consumption in the import. So all else equal, hypothetically, we hypothesize that an increase in or the rise of renewable energy would reduce LNG trade if these variables are behaving as substitutes. And environmentally speaking, that would be the hope, right? Like that's the initial, let's say, expectation that we slowly decarbonize our sectors and depend less and less on fossil fuels such as. And of course, if it's a positive outcome, that would mean that or evidence in favor of being complementary products, and which would be also problematic from an environmental perspective, meaning that we would be increasing all our resources simultaneously. However, there's some evidence of this in some even more general literature of whether it's the rebound effect or the paradox that some renewable energy or especially heavily subsidized renewable sectors may in fact stimulate more usage of some type of fossil So green is our main variable of interest. We use it interchangeably in the paper and here as a proxy for energy transition policies or environmental policies, but in all cases, we technically need the strictness of energy policy in terms of the energy mix. That is this. Finally, WTO is a binary or dummy variable that takes the value of 1 if both trading partners have existing membership the WTO and 0 otherwise. So this allows us to have a proxy for the role of trade institutions or in amplifying emissions potentially through international trade or in LNG. There's plenty of literature on what is the role of trade in amplifying emissions, because in one way or another, if we, let's say, gain perfect progress in decarbonization in one part of the world, while we still continue international trade and increasing dependence on imports from other countries. So it's just cross borders of emissions, and we have what's called with leakage, and that would be an issue, especially if you don't account for it. Finally, it's just the remaining variables I include that were mentioned earlier. It's just standard spin. So these are just quick descriptive statistics of variables and the sources, all readily available sources. We have the trade data from UN Comtrade, GDPs and the energy variables from the World Bank, and finally information regarding having an active WTO membership is from the World Trade Organization. So estimation results, as I mentioned, I'm focusing on the applied side here, or I maybe provide so many tables and bore you with all the numbers. Just to provide a quick comment, what are these outcomes? Firstly, I include, it's essentially we're asking the same question more or less. To what extent is there a substitution effect between the rise of alternative energy and LNG? However, we conduct this across various specifications and even using different methods to have more robust interpretation of analysis. I will start off with the general global model, then I will continue with the subsample analysis. So to start with, we have results where the dependent variable is the value of LNG trade. The differences between these models is basically we're just gradually increasing our dependent variables and comparing results. All else equal, the green index behave similarly across the models. That is, we find evidence in favor of partial substitution. So the rise of alternative energy does seem to reduce dependence on LNG in particular. However, we further expand this in more econometrics using more specifications and compare results. When we look at trade as a volume of LNG, we also find it with a similar statistical significance and sign relationship. And so is when we look at the dependent variable or measured using the value of LNG trade per GDP or even volume of LNG trade per GDP. So, however, following the fixed effect estimation, we conduct GLS estimation. And this is because we had some concerns regarding the heteroscedasticity in the specification, though we use robust standard errors, which is standard techniques, but still for further analysis or further robustness checks, we compare with the GLS. In terms of the green index, we still find the same results hold, statistical significance or stronger statistical significance in this case, but with the same sign, relationship, and similar magnitude. However, the overall model becomes more, let's say, theoretically consistent once we use the GLS estimator. And that is, so first, the variable of interest, as I mentioned, it's evidence in favor of a substitution effect, which also means evidence against a green paradox in this, according to this result. We also find, for example, that without going into so many details, but for example, having the WTO does actually have a positive, all else equal, of course, has a positive impact on LNG trade, which is theoretically, of course, you'd expect this, but it just makes us think or wonder on what's the role of trade in all this energy transition, and to what extent is it really accounted for. This is more of a global perspective, but also we could further consider the role of regional trade or FTAs. Of course, if the trading partner or trade takes place between similar economic structures or type of trading partners, this is not a big issue because potentially they'll have a similar, let's say, regulation scheme or type of environmental policy strictness. But usually it's the issues when you have trade takes place between trading partners which have different or laxer environmental policies, which could result into more and more carbon leakage. Finally, now let's have a quick view on the subsample analysis. 5 minutes, okay, or less. Anyway, so the subsample analysis, we conduct it in 2 ways. First is we compare between OECD and non-OECD countries, and this is basically it gives us generic distinction between based on economic development. Of course, you can argue that within OECD and within non-OECD there are further differences, but that's the first start. And then we continue to, so this is just basically splitting 2 regressions and comparing results. Time periods, again, we distinguish between 3 time periods. What we find basically when we distinguish between country groups is the notion that OECD economies have a consistent outcome with the global specific. That is, or actually it's even, the magnitude is a bit larger here. So it is again evidence in favor of a substitution effect between those variables, which also indicates that perhaps the, if we can call it progress at the global level, is mostly driven by what's happening in developed world. However, when we look at non-OECD economies, we find an insignificant relationship between rise of alternative energy and LNG. So again, as I mentioned earlier, that there are different types of country groups in non-OECD countries. But if we take a few examples, we could hear, for example, in some part of the world, especially in the Middle East, perhaps that there's rise of perhaps alternative energy projects and ambitious plans. But the extent to which is there a structural, let's say, mechanism for the substitution effect and to actually substitute between resources, or is it just increasing in all resources at the same time? And on the other hand, within non-OECD, it's also a big part of Asia and emerging markets with increasing dependence on energy resources, including LNG and alternative energy. It might be a bit, again, less consistent to have substitution effects, given the nature of their growth experience, and increasing dependence on energy demand might make them fall short of that substitution effect. But of course, more research is needed to dig deeper to distinguish again between perhaps the type of markets, because as we maybe are aware, LNG markets at least are not very, or at least relatively speaking to other energy resources, are less, let's say, global. At least they, to a certain time, they were more regional markets, and that may be interesting to maybe compare between European markets versus the Asian market and happening in the US to have more maybe concrete outcomes. Finally, when we look at the time period, we do find that we distinguish between 3 time periods, and the only significant relationship in which we find, again, a substitution effect is between 1998 and 2007. And this follows shortly after the completion of Kyoto Protocol and the rise of perhaps promotion of renewable energy. So it fits in nicely with what's happening in the real world. Prior to that, it's also expected to have a less consistent relationship between these variables. However, what's a bit problematic or slightly concerning is the following period, which meant to be that we're moving forward, actually we find an insignificant outcome between renewables and energy. Of course, various reasons could be behind this, and potentially one of the reasons is 2008 and onwards was following the rise of unconventional oil and gas, or the shale oil revolution, and perhaps this expansion in unconventional oil and gas is affecting the speed of the energy transition. And this again requires room for further research to potentially distinguish between different types of producers. So finally, what did we do exactly? We looked at, we explored the impact of energy transition policies on LNG trade using econometric methods and across different specifications. And overall, and within developed economies, we find that results indicate that the rise of renewable energy does reduce LNG trade. And this is, we interpret this as evidence in favor of a substitution. However, the results become with more and more information as we conduct additional subsample analysis, whether it's across countries or at least different economic structures and time periods. So what does this tell us? That economics matter, and the nature of different trading partners is, as we're all aware, differs dramatically. So maybe development needs and priorities of certain players is different than others, developed economies who can easily, perhaps, or they manage to substitute between resources. So this nature of different economic structure is important to take into account whenever the energy transition debate is in place, especially also the role of trade. So we looked at a global perspective. We see that having the WTO membership also, as expected, it amplifies your energy trade. But what happens to other trade agreements that potentially also help increasing emissions without taking account for that. So there is progress, let's say, but since it's a global problem and the energy transition is not really progress, it just happens in one world, in one part of the world. So it's important to look at what's happening elsewhere. Finally, what we're thinking about now is just to dig deeper and conduct more country-specific or even regional-specific analysis and seeing other factors that could help us understand the topic. Thank you very much for your time.
Thank you very much, Sarah. We don't have much room for questions, but maybe one.
Sure.
If there is one urgent question, please. No?
Maybe I can have a quick one, even though I know it eats on my time.
Yes.
Sorry.
I was a little, how can I say that, disappointed that you found a non-significant effect for the non-OECD countries. I was hoping that, I know that there is both a development of renewables and a lot of natural gas growth in a lot of non-OECD countries. And I was hoping that you find that this is due to a lot of energy demand growth in those countries, that the share of the energy demand growth that is covered by renewables would actually be higher than the share covered by natural gas. But apparently this is not the case. Do you think that this is the driver for your result?
Thank you. That's yeah, I would have loved to have all the substitution effects, but I think, so bear in mind that this is a time series, right? Between perhaps all the renewables project that we hear about are a bit more recent. So perhaps if we conduct the analysis, let's say 10 years time and compare, we hopefully could receive a different outcome, because this is a econometric analysis between 1988 and 2017, and much of the progress is quite recent. And the important question is, the progress in renewables really there for substitution, or is it just increasing our dependence on different types of energy resources? And this is, I think, the main issue that requires further research. Thank you very much. I would like to see this also perhaps for monthly data and compare. I'll give you an answer hopefully soon. Thank you.
We cannot hear you.
Thank you very much. Yes. Thank you, Franziska. I think the floor is yours now, and sorry for the delay. Thank you, Franziska. Please go ahead.
All right, we go to full screen mode. Very good. Yeah, thank you very much. I would like to present a more long-term analysis where we looked at freedom gas to Europe and did scenario analysis with the global gas model. This is joint work by me, and I work at the German Institute for Economic Research, but also at the Norwegian University of Science and Technology. And my colleague Ruud Egging is also with NTNU. And our colleague Victoria Czempinski was with DIW at the time we wrote the paper. It is now with TU Berlin. And we've used the model that we've had for many years and thought, well, there's this big question now, how do US LNG exports to Europe develop over time? This is a draft paper that we submitted to Research and International Business and Finance. And we had some first results in a short policy brief last summer because we didn't want to wait for the publication to come out. Now, what is freedom gas? Maybe you've heard the term already. We found it pretty funny because it reminded us of freedom fries. And it was actually termed by officials of the US Department of Energy in 2019, basically saying, well, this is much better natural gas than any other, in particular than Russian natural gas supplies to Europe, because it comes from the United States. And Europe is really the battleground, let's say, for this freedom gas versus non-free or Russian natural gas. And this is because in Europe, we have both natural gas imports via LNG, as we have it via pipeline. We have a number of LNG terminals in Europe, many of them already for quite some years or decades even, but also many new ones, in particular in Eastern Europe. We have about 200 BCM LNG import capacities and a number of projects still on the table or even under construction. Yet we must say that for Europe, our main import route is via pipeline. If you look at, here, this is data from 2019, the imports to Europe were to about 3/4 coming by pipeline and only about 1/4, even less, by LNG. And this is quite different in other regions of the world. In Asia, it's almost the opposite, and even more pronounced, because there only 14% of imports come by pipeline, while 86% come via LNG, and the global average is about half. And of course, this is very much related to our geography. I mean, we do have a dense natural gas pipeline network, because we are landlocked. We are, let's say, a continent that is related onshore, so by landmass, to other regions in the world. So Russia, but also North Africa is really not far, and can import from there by pipeline. And then we have other sources like the Middle East or Central Asia that could potentially also bring natural gas to us via pipeline. So it's really a geography-related issue, while in Asia, a lot of importers are harder to reach by pipeline, even though there's now a little more pipeline construction. LNG, I mentioned, it's been a source of imports to Europe for many decades, since the 1970s, but it's always been a relatively small share. The main problem not being the pretty high capacity of LNG import terminals, but rather the bottlenecked pipelines to bring the LNG from the terminals to consumers, potentially also in other countries. So really the transport across Europe has always been more of an issue than the import capacity of the terminals. Because natural gas markets are still relatively segmented in Europe, at least compared to what the European Commission, for example, wants. However, there has been quite some development in at least a couple of hubs of marketplaces in Europe, in particular in Northwest Europe, the TTF, the Tidal Transfer Facility, which have developed to become liquid markets with high churning ratios and really liquid in the sense that somebody who offers natural gas, who offers LNG, will find a buyer and has a meaningful price signal. And this is something that we see in the data a little bit of the last years. I mean, LNG exports or LNG imports into Europe were relatively low in the last decade, but they increased towards 2018 and even more in the periods that not on the slide, the 2019, 2020, because those liquid markets offered sort of import places of last resort. We have a pretty diversified import portfolio. We import from the Middle East, from North Africa, increasingly now from the US, and also from Russia, increasingly now that we have the possibility, but also from, let's say, the Americas, like Trinidad, etc. In the past, much of that, in particular, those trades that have happened for many decades, were tied in long-term contracts. But again, with those liquid markets, we also see increasing spot trade, short-term trade, basically. Now, one of our suppliers of LNG has become the US. And the US, which 15 years ago still were importers of LNG, have turned to become exporters because of shale gas. We discussed that yesterday in one of the sessions. And they've turned to becoming exporters of natural gas by 2015, 2016, and have increased their LNG exporting capacities and their LNG export volumes pretty quickly in the last 5 years. Here you see numbers until 2019. You see those huge increases from year to year, plus 60% from 2018 to 2019, and it's not on the slide, plus another plus 30 from 2019 to 2020, despite COVID-19. And at the moment, we have 6 terminals up and running, and there is projects either under construction for expansion or for new terminals for about 5 or so, and planned for another dozen or so. So there's a lot of dynamic movement and development in US LNG exports. And we just heard in the morning in the first presentation by Joel that this has also been part of a big change of market structure, because much of that US LNG is actually short-term traded LNG, actually all of it. Now, seeing this big rise in both US LNG exports to Europe, but also overall LNG exports in the last couple of years, some people, and in particular politicians, were wondering if US LNG couldn't play a bigger role in Europe, in particular, a role big enough to replace the high share of Russian natural gas. So our research question essentially is, which role is there for US LNG in Europe in the long term, sort of in an equilibrium until, or an equilibrium pathway to 2050? The question is, are those high US LNG exports that we saw in 2019, a bit still in 2020, the new normal, or were they an exception? And do we actually need even more LNG terminals because of that, in particular in Germany? This has been a big question in the last 5 years or so. We've had plans for an LNG terminal for more than 30 or 40 years even, never built one, and plans were revived and became more concrete also for new sites in the last 3-4 years. And there are now 3 terminals planned, and it's a big question here: would it actually be rational to build those terminals? And we also want to look at well, which factors or drivers would it need to influence the long-term role of US LNG, in particular in Europe, but maybe not exclusively, but also in Asia, which is actually the big importer of LNG, as I said. So we use the global gas model, which is a model that we made available open source at the NTNU website, which is a model which distinguishes multiple player types: the producers, the traders, which are actually the trading arms of the producers, liquefiers for LNG, and regasifiers, of course, and potentially storage operators for doing interseasonal storage, and then final markets. So we in the past programmed that as an MCP, as a mixed complementarity model in GAMS, because that allows, this type of model allows to solve the optimization problems of several player types simultaneously, which is what we want, because we really want to take into account the value chain at once. And it also allows to include market power by suppliers, be implemented with the trader player type, because it is a concentrated market, in particular in Europe. Because of the large model size, which took hours to run and even often did not solve, even though the model was was formulated correctly. We actually reformulated that as an optimization problem with the same properties as the MCP model, which was proven by my colleagues Ruth and Davud Ansari in a couple of papers. So we use really a global model which covers all countries that are either producers, consumers, or transit countries for natural gas. And we implement a number of scenarios. Here it looks like we implement 5 scenarios, but it's actually an even higher number of combinations that we have. We have our base case, which is based on the IAEA new policy scenario from 2018. It always takes some time to implement new data in a model. So it's not yet the stated policy scenario, which is the equivalent of today's world energy outlook. So we take the demand growth rates for the different world regions from that and apply that to our demand nodes. And for Europe, we implement the reference scenario 2016. And for those that are from Europe, you maybe have in mind that those are very optimistic demand development scenarios, or pretty much stable natural gas demand in Europe and continuous demand increase in the rest of the world. And then we do some sort of either support or disruption scenarios to see, well, where do the results that you find in the base case actually differ. We named them after some politicians because much of those different ideas are really political ideas to support or to potentially disrupt. So we named Trump, because it was written in 2018, 2019, actually, well, no, 2019, 2020. We named Trump the scenarios with financial support to US LNG exports to Europe. So basically, we reduced the shipping costs, the transport costs between Europe, between the US and Europe by a percentage rate. And the scenario also includes sanctions on finishing Nord Stream 2 pipeline, which we implemented having a delay on the moment when the Nord Stream 2 pipeline becomes operational. We assume here 2030. Again, the data set was done in 2019. So we actually thought that by 2020, Nord Stream 2 would be operational and then not operational by 2020. And for the next 5-year period, which is the time period that we use in the model, 5-year periods. An alternative is the Putin scenario, probably doesn't need much explanation, where we assume that all Russian exports are to Europe are disrupted. It's really a counterfactual scenario. Don't think of this as a realistic scenario. Then another alternative is the Altmaier scenario. Altmaier is the name of our Minister of Economics here in Germany. He's one of the big supporters of LNG import terminals in Germany. And we implement this scenario with either decreasing capital costs or decreasing operational costs of regasification terminals potentially in Germany. And the exact same type of scenario is what we call the Jinping scenario, where LNG import terminals in China would be further supported, basically to allow for even more imports of US LNG in China. I will focus on EU results, though, even though there is an Asian scenario included in the scenario set. What we find, even though it's maybe a little hard to see, is that EU supply is diversified and relatively little affected by any of the scenarios. In particular, total supply is relatively insensitive because there is a lot of natural gas available in world markets to replace if there is a change in any of the scenarios. So we find that the Putin scenario does reduce our supply somewhat visibly across the year. So this is the first always in each period. And the base case is the middle case here. And the Trump 000 scenario, which is basically a scenario which means that that 0% of the transport costs are implemented. So it's a full subsidy scenario of LNG exports from the US to Europe, that this raises total supply to Europe a little bit. And in particular, you can already see here, it raises total supplies from North America, NEM is North America, to Europe substantially. In the base case, this is, well, 2050 is very extreme, but in the 2030, 2040s, this is hardly more than we import from the US today, about 20, 25 BCM. But in a full subsidy scenario, this could be quadrupled. And the same, it could also be quadrupled in this. I'm sorry, it could also be almost quadrupled in a scenario where Russian exports to Europe are disrupted. So it's also sort of an insurance in a scenario of disruption. Yet, it's not the high numbers that some actually foresee and that you could foresee if you look at all the plans of LNG expansion in the US. But we believe that much of that expansion will actually not go to Europe, but rather go to Asia. And that's exactly what you see here. This is the total bars are US LNG exports. And you see that the largest share goes to Asia Pacific. It's the upper share, and it's usually the largest, except in the scenarios with full subsidies of trade to Europe or disruption of Russian supplies in Europe. Other than that, the US exports to Europe, which are here the shaded parts, are relatively small. And it's really Asia that takes the bulk of US LNG exports in the equilibrium. And that is, of course, sort of part of a price quantity result, and it's driven by the price difference between the regions. Here you have actually in the lower end and the lighter colors, the prices for the model result prices for European nodes, Italy, the UK, and France, and Germany. And in the darker shaded lines, you have Asian prices, in particular long-standing LNG importers as Japan and Korea. And you see that also the Chinese prices are converging towards those East Asian prices. And the gap between EU or European, I should say, European and Asian prices is widening over time, really increasing that effect that Asia draws much more of the global LNG supplies. Where do US LNG supplies to Europe go? Well, they go as also today to a multitude of countries, really from small Eastern European terminals to the larger terminals on the Atlantic shore. It's a diversified picture. Again, it's small base case volumes. Also, I didn't mention that yet, the Jinping scenario, so the Asian support for even more regasification terminals doesn't hardly have an influence on US LNG supplies to Europe. Equally, also the Altmaier scenario, so the support scenario for Germany hardly has an influence. The subsidy levels, I already said, substantially increase US LNG to Europe, and the higher the subsidy, the higher the quantities, and the Putin effect I also mentioned. So here's a comparison actually for those different subsidy levels. This is the highest one, which I also showed in the previous slide, so the full subsidization scenario, and we see that also with somewhat lower subsidies, this is here 75% of the costs covered by subsidies, and this is half of the costs covered by subsidies, also reach pretty high levels of LNG exports from the US to Europe already. Yet in the case which we call 100, which is the case with no subsidies, but still the Nord Stream 2 sanctions, so the delayed operation of Nord Stream 2, we find only a small effect, even in the 2020s, which is the period in time, the period in question, because after 2013, then Nord Stream 2 would be available. We have a relatively small effect, and we think that really questions the effectiveness of, at least within natural gas economics, of those sanctions that are still in force on the finalization of the construction of Nord Stream 2 pipeline. So it doesn't provide a commercial argument or commercial opening for US LNG exports to Europe, the sanctioning policy. Again, as I said at the beginning, the LNG subsidies lead to somewhat higher consumption in Europe, even though it's a relatively small effect. And let me, last one, look at the LNG terminals in Europe very quickly. We find relatively small volumes only in the full subsidization, both of operational and of fixed effects of investment costs. We find relatively large volumes of LNG being imported actually to Germany. In the case where sorry, my mouse doesn't want to. In the case where the operational costs are not subsidized, but only the capital costs are subsidized, which is one of the scenarios under discussion here. We find actually really small LNG volumes only. This is the 100 case. So hardly any justification for giving those high subsidies to capital costs. Rather, subsidization of operational costs, particularly at the full subsidization scenario, leads to relatively, I mean, 10 BCM is not that small for Germany, relatively high LNG imports. And if we actually went for those subsidized LNG imports and the LNG terminals, that would be at the expense of Norway, one of our traditional suppliers to Germany. So it would actually reduce here those blue, both blue volumes in our supply mix in Germany. I'm not sure if you really want to do that with such a reliable supplier. It wouldn't be at the expense of Russia. So to conclude very quickly, US and other LNG can serve as insurance for European natural gas consumers, as I showed in this Putin disruption scenario. But overall, in sort of the equilibrium in the long run, Asian markets are more attractive for US LNG. Only in temporary effects, it can be seen that liquid stock markets, liquid spot markets of natural gas, and also liberalized storage capacities, which I didn't discuss today, make Europe a destination of last resort, in particular in times of global overcapacities, as we have today. So I would conclude that there's no economic rationale for new LNG terminals in Europe, and they are really feasible only if they are subsidized. Thank you very much.
Thank you very much, Franziska. Okay, so we have very little time for questions.
It's a break already, yes.
Is there any urgent question for Franziska? No?
I would have a lot of questions, but maybe Laurent, I'll let you go ahead. I'm sure.
No, go, please, Joel, please.
No, Laurent, go ahead. It will be more accurate from your side.
Yes, but I would like to discuss a little bit more your paper, Franziska. It's very interesting, very inspiring, especially for Joel and I in Total Energies, because we are involved with a LNG portfolio. There's a lot of US volume within, so it's quite a tricky questions where do these volumes will go, either in Asia or in Europe. I understand that it depends on, I would say, some political decision, subsidies for on the US side or the European side. And also what is important, and but you just take an assumption, it's also the gas demand in Europe, because if I understood, you consider the IAEA scenario of 2018, and I assume it's quite a flat demand for gas in Europe, but we see with the Green Deal and so on, some decreasing gas demand, and so the competition between Russian gas and US LNG is tougher, I would say, and it's yes, it's very interesting to have insight on those parameters. I was also very interested in the price spreads you show between Europe and Asia. It's in euro by cubic meters, so it's a little bit hard for me to read. It's easier when it's in dollar per million BTU, but okay. Fair enough.
It was increasing, so it's okay for us.
Very interesting. So it's, yeah. And I understand that but correct me if I'm wrong, that in your scenarios, in the most, I would say, probable one, US LNG will be attracted by Asia, and Europe will remain somehow at the current level, which are quite high. In 19 and 20, there was a big amount of US LNG that flows into Europe. And except if there is a big decision, there will be no surge in US volume in Europe. Am I correct?
Absolutely. Yeah, that's really the point. There is no further increase to be seen. Yes.
And finally, you are quite pessimistic about a regas terminal in Germany.
Yes, and I think that's confirmed by the recent decisions by the project developers.
Yeah, they stalled the project because, yeah, so it's okay. Very, very interesting. I don't know if there is other questions.
Yes, maybe just a suggestion from my side. Indeed, you check the gas demand, which is key, but also the LNG supply. So if tomorrow we see Qatar building new mega trains, it will be a big challenge for LNG suppliers such as us, but a very good opportunity for LNG importers. So indeed, for example, I take the example of Qatar because it has both intrinsic and extrinsic value in its production, because it produces a very low cost, and it can choose its destination east or west much easier than the US can do. So indeed, if it's not the US LNG, I'm quite confident that it could be some other sources which are developing and which are not indeed not forcefully Russian, but yes, Qatar would be a good opportunity to supply new gasification capacities in Europe, but that's a personal suggestion.
It is really a point of discussion. I mean, we find Asian LNG demand to be so high to absorb all of this growth also.
Okay.
And therefore Europe really staying at current LNG import levels.
Okay.
But as my colleague usually says, but it's contingent on those non-rational Russian terminals or Russian projects, Nord Stream and Nord Stream 2, taking such a big role in European supplies. Thank you. Well, we cannot hear you, Laurent.
We can't hear you, Laurent.
Yeah, so we are already out of time. So thank you very much for all the panelists. It was very interesting. I really enjoy being back into a kind of, let's say, conference with professionals and academics. It was very inspiring, refreshing. I missed the physical conference because I would like to have a discussion around the coffee with all of you. I have a lot of questions, really. Maybe I will write you some emails. Don't feel free not to answer me. And wish you a good day. And thank you very much again. And happy to see you maybe physically next year or in a couple of years. Bye bye.
Just a little reminder for the speakers to update your presentation on the dashboard of the conference. And that's it for me.
Thank you to your
Thank you very much.
Yes, thank you very much.
Thank you.
Thank you, everybody.
Thank you all.
Bye-bye.
Goodbye.
Bye. Bye.